inheritance taxes in France are challenging. Um, the benefits of the tax treaty for income taxes, which is outstanding for U.S. citizens, can be a little bit offset by some of the challenges with inheritance taxes. In the United States, we're also very lucky because our inheritance taxes, or what they would call estate taxes, are are almost non-existent for the majority of people. There's a huge exclusion. I think it's now, is it 14 million per person in the United States? So a married couple with an estate worth $28 million could pass away in the United States and not owe any estate taxes, which is kind of crazy when you look at the way it's done around the world. Um, Unfortunately, it's not that way in France. But again, we know again about the benefits of the tax treaty for income while you're alive and living there. And Thomas is going to go through some of the aspects of estate planning that you should be aware of, and also some planning solutions that are out there to help alleviate this if it's a concern for you. So, Thomas, if you want to share your screen and get us started.
Yes, give me 1 second. Okay, so can you confirm that you can see my screen, Tommy?
I can see it.
Okay, so as Tommy explained, I'm Thomas Dubanchet. I'm a French tax lawyer, and I'm based in Nice. I mostly advise US families who are moving or investing in France. Today, I try to give you a clear overview of how to navigate French tax residency, property acquisition, and cross-border estate planning between France and the US. We'll cover three main topics. The first one being, when do you actually become a French tax resident? The second one, which is of importance, is how to structure your real estate purchase in France. And the third one, who will be how to plan inheritance and wealth transfer efficiently across generation. So let's go on the first topic, which is very important, which is, when do you become a French tax resident? This is a topic that is generally misunderstood by many of my clients, because I'm very often hearing about this 183 days rule, which in practice does not really exist. So how does French tax residency is assessed? Let's start with the basic. So first of all, we have to look at Article 4B of the French General Tax Code, which states that you are considered a French tax resident if you meet any one of the three following criteria. The first one is if you have your main home or habitual place of stay in France. The second one is if you have your principal professional activity in France. And the third one is if you have in France the center of your economic interest. So you just have to meet one of these three criteria to be considered as a French tax resident under the meaning of the French General Tax Code. So it's very easy to be considered a French tax resident under the meaning of the French General Tax Code, because let's say that you rent out an apartment in Nice, for example, and you stay there even for less than 6 months, I would say, the French tax authorities can consider that you have your primary home in France. But that's why, as Americans, you are protected by, by the tax treaty, which provides for what we call some tiebreaker rules. It's so let's say that both the US and France consider that you are a tax resident of their respective country, which could happen because you are a US citizen. So anyway, the US will treat you as a US tax resident. And if France also treats you as a French tax resident to avoid being considered a tax resident of two countries. France and the US have agreed on tiebreaker rules to determine where each individual has his tax residency. So the first criterion, and so it's different than the rules regarding, I mean, that than the French rule, the tiebreaker rules must be looked at one after each other. So it means that we will first look at in which country you have a permanent home. So let's imagine that you only have an apartment in France, and in the US, you no longer have a home because you've sold it before moving to France. Then you will be considered as having a permanent home only in France, which means that you will be considered only a French tax resident according to the tax treaty. But sometimes, I mean, you can keep a home in the US and a home in France. In this case, you will have a permanent home in both countries, which means that we will have to go to the second criteria, which is the center of vital interest. And the center of vital interest, it's a very subjective criteria, but I mean, we will need to determine where you have the strongest personal and economic ties, but there is no hierarchy between these two type of ties, meaning that we can face a situation, and I'm facing it often with my clients, where they have their personal ties that are more in France because they are living there with their husband or wife, and I don't know, they have friends in France, for example, but they keep their economic ties in the US because they have their IRA, their 401k there. They have, I mean, their pensions come from the US. All their investments are in the US. So in this case, you could be in a situation where the center of your vital interest will be undetermined, because if you have the center of your personal interest in France and the center of your economic interest in the US, your center of vital interest is in France and in the US. So in this case, if the center of your vital interest is undetermined, we have to look at where is, so at the next criteria, which is where do you have your habitual place of abode. And the habitual place of abode, we are not talking about spending 183 days somewhere. It's just the country in which you reside, I would say, more than as a tourist. So once again, it's very subjective, but let's say that if you are, for example, in France for 8 months and then you spend 4 months in the US, we could defend that you habitually reside in the two countries, because I mean, you habitually reside in France, you spend there 8 months a year, and you habitually reside in the US, you spend there 4 months a year. So in this case, if you have an habitual abode in the two countries, the next criteria that has to be looked at is the nationality. And let's assume that you are only US citizen. It would mean that you will end up being a US tax resident. So what's important for you to remember is that it's very easy to become a French tax resident according to the French tax rule. But then if France treats you as a French tax resident, you have the tax treaty that can protect you, and we can play around. It's not really playing around, it's just using the tax treaty and the way it works in order to, if it makes sense for you tax-wise, to organize your life in France to avoid becoming a French tax resident. And that's where I will come on the next slide, which is how to avoid French tax residency. Well, if you want to avoid French tax residency, you have to either meet one of the tiebreaker rules, so one of the four first criteria that I showed, a permanent home. So let's say that you don't have it will not happen, because if you move to France, you will have a permanent home there. But if we are able to prove that you have both your personal ties and your economic ties in the US, the tiebreaker will be in the US for the second criteria, which means that you will be treated as a US tax resident. So to avoid becoming a French tax resident, the first thing is you must maintain an address in the United States, which is available to you. So, meaning if you only have rental real estate in the US, it will not work. You must have a place in the US that can be available to you if you decide to go there anytime. And in addition to that, you must travel back to the US quite often. And since all these conditions are quite subjective, once again, it makes a lot of sense to take advice before moving to determine whether, I mean, first of all, what would be the French consequences in terms of inheritance tax if you were a French tax resident, and then if these consequences are too high for you, we can work with you in order to secure your non-French tax residency. And how does it work in practice? So what I do very often for my clients is we have a procedure in France that you call a tax ruling. And I know it exists also in the US. It's a tool that you can use. So let's say you come to my office and you tell me that, I mean, you love France, but not to the point to pay 45% tax upon your passing. And you are okay with staying, let's say, 3 to 4 months in the US each year. It's okay for you. But so to secure your non-French tax residency, we can file a tax ruling. So it's a letter that we send to the French tax authorities where we explain in detail what are your factual circumstances, so the way you intend to live, how your assets are structured, how do you, I mean, the length of your stay, the expected length of stay in France, in the US, etc. And I will ask them to confirm that, provided that you don't exceed this threshold, that the French tax authorities will not consider you as a French tax resident. And they have 3 months to reply to this request. And if they approve the request, it's binding on them, meaning that, let's say that you pass away while living in France. If, like, your children, if they are your heir, don't file a French inheritance tax return, and a French tax inspector claims that inheritance tax should have been paid in France, your children will be able to show this tax ruling and it will protect them. So it's a very powerful tool, but it must be made in advance. And of course, you must respect the condition that we have presented in the ruling. If not, it will not be binding on the French tax authorities. Then, so I don't know if there are some questions or if we do the question at the end, Tommy. What do you think?
Let me just go through and see what we have so far. Alfred was asking if, irrespective of these criteria that you went through, if someone comes to France on a long stay visa and they're there for 90 days and then they apply for French national health care, is that pretty much going to tell the French authorities that you are a French tax resident, like you're planning to be a tax resident, do you think?
Yes, it's an indicator, but it's not like not in every. So we could imagine, because it's not. Let's say that this health insurance will be one of the personal ties, I would say. So let's say that this person has keeps a home in the US, has a home in France, he asks the French health insurance in France, it will give some weight in France to the personal ties, but it will not change the economic ties. So for sure, in case of tax audit, we will not be able to defend that his personal ties was in the US because if he asks for the French health insurance, it's a strong indicator of personal ties in France. But then he can still have his economic ties in the US, which will mean that the center of vital interests will remain undetermined, which will bring us to the next criterion, which is habitual abode. And
Mhm.
provided that he stays frequently in the US, at least enough to be considered as having an habitual abode in the US, we will have to move to the next criterion, which is the nationality. So no, I mean, it's of course my advice if you want to secure your non-French tax residency would be ideally to not get the French health card from the French social security,
Yeah.
but you can manage getting it and still not becoming a French tax resident. It's doable.
Okay. Very interesting. Let's see. I may save the rest of these for the end. Hanny is just asking, how do you bridge the again a similar question to what we just asked? If your French tax residency versus your immigration status, because immigration and tax are two separate
Mhm.
government entities. So again, if you apply for a long stay visa, I assume that's an indication that you're planning to live, you know, to reside in France. Maybe
Not
not
really.
permanently, but is that just another one of those that'll go into the column of here's when your personal interest?
Exactly. It's the
Okay,
same. I mean, if you ask for the long stay visa, it's also an indicator that your personal ties are more likely to be in France. But I mean, it does not make you automatically a French tax resident. So to assess the French tax residency, we must take into account many elements and then decide. But one single element does not make you a French tax resident. It's really the conjunction of elements that will make you or will not make you a French tax resident.
gotcha. All right. Why don't you continue with your presentation, and then I do have a bunch of questions. So once we get through that, we'll just open it up and talk about some of these.
Yes. So the next topic is how to purchase a real estate in France. And I've split the presentation in two scenario, which is the first one purchasing as a US tax resident, and the second one purchasing as a French tax resident. So we will start with the first scenario, which is that you are not a French tax resident, but you want to buy a house in France, and you are looking at the most tax efficient way to purchase it in terms of estate tax, inheritance tax, and gift tax. Um, so, of course, it's not legal advice what I'm doing here. So there could have some other elements that will make me change my decision in the end. But I will just give you the general idea and what you must have in mind and what works for the vast majority of clients and why does it work. So when you are considered as a US tax resident, it makes sense to purchase your French house through what we call in France a French Société Civile Immobilière, a French SCI. Why does it make sense? And of course, it depends if you buy with a financing, if you buy and you pay cash. I mean, all this needs to be assessed precisely. But generally speaking, it's more tax efficient to purchase through a French SCI because the tax treaty between France and the US provides for to simplify provides for a full exemption of French inheritance tax at the time of passing. Why? So I will try to go in more detail, and it will be a bit more complex, but how it works is that, let's say you are in the US, I will help you set up a French SCI. The French SCI will purchase the French property, but you, as an individual, will pay for this property because the SCI does not have any money. So you will pay yourself to buy the real estate, but on behalf of the SCI, which means that after this operation is complete, you will have the SCI, which will have, as in the column of the assets, it will have the real estate property. Let's say it's worth 500,000 euros. But then, since you as an individual, you will have paid 500,000 euros on behalf of the company to purchase the property, the company will have 500,000 euros of liabilities toward you as the shareholder. So meaning that the value of the shares of the SCI will be zero. And when you look at the tax treaty, the only assets that are subject to French inheritance tax at the time of passing are the value of the real estate or the value of the shares of the company. And in our example, the value of the shares, the net value will be zero because you will have an asset worth 500 and a debt worth also 500. And the debt that the company has toward you will be considered as what we call a receivable. So it will be a sum of money that you, as the individual, will be able to claim against the company. So it has some value. But when you look at the tax treaty, a receivable is only taxable in the US, which means that, generally speaking, for a US tax resident, if you purchase with a French SCI, the value of the shares is zero, and the value of the receivable in our example will be 500, and this 500 will not be taxable in France. It will only be taxable in the US, which is, as Tommy said, I mean, the tax allowance in the US is currently 14 million, and in 2026, it will go up to 15 million. Whereas in France, in direct line between parents and children, we are talking about 100,000 euros allowance. So it can make you, it can give you, like, your heir, a big saving in terms of inheritance tax.
Thomas, I just want to clarify this, make sure I'm understanding it correctly. So the benefit of the SCI that you're talking about, where you have zero inheritance tax liability, that's just in comparison to if you, as a U.S. citizen and a U.S. tax resident, wanted to just buy a second house in France just to visit, and you didn't buy it through an SCI, then when you passed away, the value of that property would, so again, if it's 500,000, that 500,000 then would be, even if you're not a tax resident of France, because it's in France, that would suddenly become a taxable liability.
Exactly. Yes. So just by purchasing through a French SCI, you can really, I mean, completely offset any French inheritance tax on your French real estate. So it makes a lot of sense because, as you said to me, like, same example, but the property is purchased in the own name of the individual. The 500,000 euros will be subject to French inheritance tax. So it's a significant difference.
Thank you.
So the second scenario is to give you an idea of the type of structure that we can implement when someone, I mean, wants to purchase, or when a US tax resident wants to purchase a French real estate, but he knows that he will become a French tax resident in the future. So in this case, we can use a usufruct bare ownership arrangement. So it's technical. It's something that does not exist in the US, but which work in France and does not create, I mean, it creates some complexity in the US only if your estate will be above the 14 million threshold in the US, because it can cause some double taxation. But if you are taxed twice in the US, but still below the 14 million threshold, it's not a big deal because in the end you will not pay tax. But yes, if you are close to the 14 million threshold, it might not work, or at least it will need to be structured differently, and we will need to have like a discussion with your US attorney to see how it will be treated there. But to give you like the step of how it works. So you are still a US tax resident, you've seen a property in France that you really like, you plan on, I mean, living in this property, but you don't want your children to pay too much inheritance tax. So what you can do is, prior to moving to France, you make a gift to your child while you are a US resident, just enough for them to buy the bare ownership of the property. And so you will buy the property with your children. So you will buy what we call the usufruct. It's the right to use the property. And your children will buy the bare ownership. So the property will be split. It's somehow similar to a trust, but it's not a trust. It's really a concept that does not exist in the US. But the main advantage of this structure is that when the holder of the usufruct, that we call the usufructuary, when this person passes away, the full ownership is recreated on the head of the bare owner without French inheritance tax. So meaning that when the usufruct terminates, your children will become full owners of the property without paying any French inheritance tax. So it's a very powerful tool that can be used in certain situations. I think yes, and the last aspect that I wanted to address regarding the optimization that can be made regarding inheritance tax, it's the situation which is particularly common where US families are split between France and the US. So we can imagine a situation where the grandparents, for example, are US tax residents and their children and grandchildren reside in France. Let's take like the like if the grandparents, for example, if they have a brokerage account, let's take this assumption. When the grandparents pass away while French tax residents and the children who are French tax residents inherit, there is no French inheritance tax to be paid because of the tax treaty. So meaning that, let's say you move to France, you become a French tax resident, and you will receive later an inheritance from your parents who is still in the US. You will not pay French inheritance tax except if the assets of your parents include the French real estate. This one will be subject to French inheritance tax. But if you inherit from US real estate, US stocks, US IRA, etc., you will not pay tax on this transfer. But when you will pass away while French tax residents, your own children, even if they are in the US, they will be subject to French inheritance tax on the same assets. So meaning that the IRA, the US portfolio, etc., will be subject to French inheritance tax if you pass away while being a French tax resident. So what can be done is, let's assume that you move to France, but you consider that you don't really need the money from your parents. For example, we can put in place a generation skipping scenario by which you will not inherit from your parents, but I mean, it will be your own children who will inherit from your parents. And this way, we can skip a generation, and meaning that upon your passing, your children will not pay tax on the assets that you should have received for your parents. But it only applies in specific situation, but that's something to keep in mind, and that can change a lot, especially if you have enough wealth for you. Your intention is to transfer everything to your children upon your passing, and you don't really need more money from your parents for your plan in the future. So that's something that can be uh, put in place. And we can imagine creating a trust at the same time if the grandchildren are young. So that's also something that can be done. So that's this slide was talking about this strategy. Uh, so the key takeaways on that is that you must anticipate your tax status, meaning to have a consultation with a tax professional before arriving in France. That's really the most important advice is really to take tailor-made advice, really adapt to your situation, to analyze your situation, receive guidance in order to secure your tax status. And you really must see this as an investment on on your future, because as Americans, there are a lot of planning that can be made and that can help you save hundreds of thousands of euros, depending, of course, on your assets. But there are plenty of planning that can be made and that makes a lot of sense, but which are no longer accessible when you become a French tax resident. So most of the planning must be made before moving. That will allow us to leverage the treaty benefits. We'll be able to choose the right structure. So it's referring to the SCI structure that we were talking of before. And in certain situations, to plan for multiple generations. So do we have some question to address?
Yes, we do. We have a lot of questions. Before we get to that, if you want to, I'm going to put your website address in the chat so that everybody can access it. If you do you want to leave the presentation up in case you want to go back to something?
Yes, no, but it's not finished yet because
Oh, okay.
uh,
Okay. Yeah.
I've
Why don't we
of
keep going? Why don't we keep going then? And then, yeah, there's a bunch of questions we'll get to, but
okay,
yeah,
but
why
I
don't you
mean,
keep going?
let's finish the presentation if you are not all asleep yet. And so I will go over two real life scenarios that Tommy asked me to add to the presentation, because apparently it's question that you get a lot from your clients, um, which happens. So the first one is what happened in France when a French tax resident holds a US living trust, which is very common in the US, but has a US resident child beneficiary. How is it treated in France in terms of inheritance tax? The answer is quite simple, because in terms of inheritance tax, France disregards the trust. It looks through the trust and considers that you, as a French tax resident, were owning the assets, let's say, in your own name to simplify. And so, if you pass away being the grantor, the trustor of a US living trust with a US resident child beneficiary, uh, everything that's in the trust will be subject to French inheritance tax, except the US real estate. The US real estate remains subject to tax only in the US, but all the other types of assets will be subject to French inheritance tax. And the situation is exactly identical if the property were held in your own name. So having a trust doesn't change the tax treatments in terms of inheritance tax, but I should add that it's if you have a trust, it will be mandatory to review it before moving to France, because depending on how the provision of your trust documents are drafted, uh, a punitive tax treatment can apply. Because generally speaking, like when you have a trust, you will appoint a trustee, and sometimes and often the trustee will have a discretionary power to distribute the assets to certain beneficiaries. And when there is a discretionary power, France can decide to apply a punitive tax rate, which can be of 45% and in certain situations, 60%. So really, in a situation where you have a trust, you must keep in mind that it will not protect against French inheritance tax, but it can cause, if it's not anticipated, it can lead to the application of punitive tax rates. But the good news is that if you take advice before, my role is to make sure that the trust is correctly drafted and that it will not create this punitive tax treatment. The second and last situation is the situation where same, you are a French tax resident and you hold some US retirement accounts, and you pass away while in France, and the beneficiaries of your retirement accounts are your children who reside in the US. Well, simple answer, it will be subject to tax in France. There are nothing much that can be done. Uh, as long as the account holder is a French tax resident, all the assets except the US real estate will be subject to French inheritance tax. So thank you for your attention. I think we have covered all the topics. So let's see the questions that we have.
First of all, thank you, Thomas. That was excellent, and I always learn something talking to you. Yes, we have a lot of questions. Before we get to that, one thing I do want to mention, just because I know inheritance taxes can be very high in France, but just as an example, I have a little calculator that I created, spreadsheet. First of all, spouses get unlimited exemptions under inheritance law. So one spouse inheriting from another spouse, there's no taxes. If the inheritor is a parent, a child, or a grandchild, that's one like level. And for them, there's 100,000 euro exemption. Correct me if I'm wrong on this, Thomas, but 100,000 first 100,000 euros are exempt, and then there's a progressive rate. And in the calculator, I know you can't see this, but let's just say that each inheritor got 250,000 euros, and they're either a parent, child, or grandchild. Their tax liability on the 250,000 would be 28,000, a little over 28,000 euros, which equals a little over 11% of that total. If the same $250,000 went to a sibling, to a brother and sister of the decedent, that's a different rate, a much smaller exemption. Then the tax would jump to 102,000 euros on 250,000. So that's 41%. And then if you go to a niece or nephew, it's even a further relationship. Then it's 133,000 or 53%. And then for like a non-relative or a very distant relative, there's no exemption. And it's for the 250,000, it would be 149,000, which is 59%. So very significant for distant relatives. But I also wanted people to understand that if either your estate is not going to be that big, or it's a very near relative and maybe multiple near relatives. Again, if your dream is to live in France, we need to make it happen, but I also don't want you to just completely take it off the table because of inheritance taxes. So thank you for giving me just a minute to explain. So yeah, I'm going to scroll back up, and please be patient with me, everybody, because we do have a lot of questions. So I'm going to scroll back up and ask some questions. Let's see. All right. How about Francis asked, would a home that you owned in the United States but leased out, like on a 1-year lease, be considered a permanent home in the US, like for the residency decision. I told her I doubted it. If you're renting it
Oh,
out, that would tell the authorities there that it's not a necessarily a permanent home. But what are your thoughts?
yes, I agree with your view, Tommy. It's if the property is rented out, then it will not qualify as a permanent home. What you could do is maybe keep one room for yourself eventually, but if you don't, like if the lease agreement does not states that you retain the use of one room in the house, it will not work. So no, really, you must have a house in which you can stay whenever you want. So ideally, in your name, eventually it could be like I don't know. You could put your name on your parents' deed, on your children's deed, but then it became a bit tricky. The best is really to have your property in your own name and be able to prove in case you have questions that you travel there quite often in order to qualify for the permanent home.
Perfect. All right. Wendy asked, can your time out of France, so I guess this is talking about like where's your habitual abode? Can your time out of France be in a non-US country? So
No.
what if you wanted to like live in Scotland for part of the year? Could you avoid
No,
being a tax resident?
no, because you will be treated as having, let's say, you spend 8 months, 7 months a year in France. Then you spend 1 month and a half in the US, but only to visit your family and just like 1 week each time, for example. And then you spend 3 months and a half in Scotland. It's once again, it's quite subjective, but the likely result will be that the French tax authorities will consider that you have an habitual abode in France and one in Scotland. But so which which will not work for the French US tax treaty because it's only if you have an habitual abode in France and the US that we have to go to the next criterion. If you have one in France and Scotland, it does not work. It will not work.
Excellent. Thank you for clearing that up. Let's see. Gina was asking about the taxes, but I think we explained that. So if you own the see if she owns a place in France, stay there as a tax resident, pass that on to her child. That's the situation where you could do the um the usufruct.
Yes, but ideally, so it can be done, this usufruct bare ownership arrangement, it can be done when you are already a French tax resident. Just it will be less tax efficient because you will have to transfer the bare ownership to your child, in this example, while you are a French tax resident. So this transfer will be subject to gift tax at the
Mm.
same rate as inheritance tax. So you will not make a full use of the of this cross-border situation. It's best if you do it while you are a US tax resident because you can use the US allowance without using the French one.
Gotcha. Thank you. Yeah. So that's probably the most important takeaway from this whole thing is you need to consult with somebody on your specific situation before you apply for visas and certainly before you buy property in
Yes,
France.
I would say like 6 months, uh, ideally 8 months before moving, 6 to 8 months before moving. It's good to take advice. It's the good window to be able to move what has to be moved in the US if necessary, and plan and at least make sure that you don't miss an opportunity before moving to France.
Yep. Let's see. And so I think you also answered this from Kelly. If you're living in France and you inherit from US based persons, that is not taxable in France under the inheritance tax, correct? That would be under the US.
Except if you inherit of French real estate.
Okay. Except if there's
Or,
real estate
or
located in France.
or a French business. I didn't specify this in the presentation, but it's also like French inheritance tax also applies to French business. So if your parents have, they have a restaurant in France, for example, and you inherit the business, the value of the business will be subject to tax, to inheritance tax in France.
Okay. Darren, I see your question. It's probably a little too complicated. That's exactly the kind of thing that I would get in touch with Thomas to talk about. It has to do with being um, living part time in the US, part time in France, and part time in Italy. And since we're talking about three different countries, the rules would need you would need to consider what the Italian residency rules are also. And like I said, I think that's just too complicated for this call. But please get in touch with Thomas. Let's see, living trust. I think we talked about that. Um, let's see. Somebody's asking if you had residences in both US and France, does the value of the property have any impact on permanent residence, i.e., the French property is two times the value of the US property? Or is it just whether they consider it your actual, like, habitual abode?
Trying to find this question because what was the question? So who asked this question?
So if I own my house in the United States, I own a house in France. But say
Oh,
my
no,
house in the
no, no,
United
no, no,
States
no.
is worth
No,
two
no,
hundred fifty thousand dollars, but the one in France is worth $1 million. Does the
no,
value itself have any determination as
no.
far as which one is your habitual abode?
No, it doesn't have any impact in France. You can have like a 100,000 euros property in the US and a 2 million euros property in France. It will not be taken into account. But of course, if this 100,000 euros apartment in the US is only, I don't know, 8 square meter, for example, and you cannot likely live there, it will not work. So, but the price is not taken into account. It's just that you must have really a house in the US in which you live when you travel back to the US.
Gotcha. Alfred is asking about if you did the purchase of real estate via the SCI, does the value of that real estate that the SCI owns count when we're talking about the IFI or the wealth tax in France?
Yes. Yes, it does. It does. So, but you can get, I mean, when you have, it's generally better also in terms of wealth tax to purchase a French real estate through a French SCI. Why? Because first of all, you can deduct from the value of the real estate, to simplify, an allowance of between 10 to 20%. So it will reduce the value, the taxable value, because when a property is held through a company, we consider that it's less liquid. And so you can reduce slightly the value of the property. And also, I mean, it gives you more flexibility to deduct certain liabilities. So in certain circumstances, it's quite complex, but there are some planning that can be made also if you purchase a property with a SCI, which will lower your French wealth tax burden. But the main purpose of setting up the acquisition through a SCI should not be tax, because we have what we call in France a general anti-abuse disposition or general anti-abuse rule. It also exists in the US. So when you set up a structure, there must have other objective than pure tax objective, and they must be principle. So if you buy with a SCI, my advice would be to include your children in the SCI, for example, or there are other things that can be done which will give a patrimonial interest to the structure in comparison to the pure tax advantage.
That makes sense. So basically, that the lesson there is they're looking for people who are trying to game the system
Yes.
and don't look favorably upon it. Just to be cognizant, it's 12:58. if people were planning on being here for an hour and you need to get off, I completely understand. Thomas, do you mind? Do you have time to hang around for a few
Yes,
more
yes,
questions?
yes, sure.
Okay, we'll keep going, and I am recording this. I'll be sending out the recording in the next day or so. Um, so I will continue going. Oh, one thing I wanted to mention: if you heard the term IFI or wealth tax in France and you weren't familiar with that, this is not for this presentation, but there is a wealth tax, but it's only on real estate assets worldwide, and only if the value exceeds 1.3 million euros. And even after 1.3 million euros, I think the first 800,000 of that above is a 0% rate, and then there's a progressive rate. I think from like 0.5% to maybe 1.5%, something like that. Um,
It's, yes, basically
it's
that. It's very interesting topic, but which is outside of the scope of this presentation, but currently our members of parliament in France are discussing about extending the wealth tax to also other type of assets than the real estate. So it will potentially also apply to certain financial assets. So nothing definitive yet. We will have more information by at the end of the month, but that's something to be really to really look at, uh, because it could change significantly the planning opportunities.
Yep, that's important. That's interesting too because it used to be that they did include financial assets in there, and then that changed
Yes, but now
years
what they
ago.
want to do is to not include all the financial assets. What they are talking of is to only include what they call the non-productive, non-producing assets, but it's not the same meaning than in the US by non-productive assets. So they will exclude the securities, the stocks, etc. It should not be in the taxable basis, but for example, the cryptocurrencies will be included. The liquidities, if you have cash at the bank, it will be included.
Hmm.
Uh, if you have a boat, for example, yes, a yacht, a plane, I mean, different assets which was outside the scope of the IFI will be included, but they don't want to include all the financial assets because they have understood that it will cause some exit from France, and also they have been clever enough to understand that investing in stock and securities is also participating to the economy. So they don't want, at least for now, to include these elements to the new wealth tax, but nothing definitive yet. So I will carefully look at the uh, evolution on this tax, and I will keep you posted, Tommy, on that.
Perfect. We can have you back on to talk specifically about that once we get some details. Marco asked, does inheritance tax apply between spouses? And I mentioned that no, spouses get an unlimited allowance.
Yes.
Um, let's
Spouses, and
see.
also what's interesting, let's say for same for I mean we have in France a civil partnership, what we call the PAX. It's a civil partnership,
Right.
and because like when, let's say, I have a client now, she's 70 years old maybe. She doesn't have, yes, let's simplify. She doesn't have a child. She doesn't have a husband, but she wants to leave her assets to a friend of her, who also she's a woman also. And I haven't finalized the analysis for her, but one advice would be like potentially that she could just sign a civil partnership with her, because she is currently living with this woman, but they are not a couple, but they are very close friends. They are living together, and just by entering into a civil partnership, the inheritance tax will be zero. Whereas if she does not enter into a civil partnership, the inheritance tax between non-related parties is 60%. So it makes a huge difference.
Wow. Yeah, that's shocking. All right. Maxine is asking if children in the US pay inheritance tax for property acquired in France. Oh, she's asking if that's the case. So oh, I'm sorry. If children in the U.S. pay French inheritance tax for property acquired in France by a French tax resident, so again, they're inheriting it from a French tax resident, can
Yes.
those taxes offset other tax liabilities in the U.S.? And you correct me, but you cannot offset like income taxes. You could potentially offset some estate taxes, but again, that's a huge threshold in the United States.
Exactly.
But
Yes.
you cannot use inheritance taxes in France to offset income taxes.
Yes. Correct.
Uh, let's see.
It's only in case there is estate tax to pay in the US that you will be able to offset the amount of French tax on the amount of US estate tax, but only if you exceed if your estate exceeds the 14 or soon 15 million threshold.
Okay,
But
Greg.
maybe if the Democrats wins the next election, maybe they will lower this allowance. So that's also something that will need to be checked in due time.
That's true. Greg is asking, what if he is the trustee for a trust of his mother's and also the beneficiary of the trust? If he was a tax resident of France, what would happen when she passed away? So I assume she is a U.S. resident. He's the trustee and the beneficiary of the trust, but he's a French tax resident.
You will not pay. Normally, you will not pay tax on upon his mother passing. But one very important aspect that we didn't have time to cover today, it was not the subject of our presentation, but if we take this example where you are trustee and beneficiary of a US trust and you are a French tax resident, there are some specific returns, some specific declaration which have to be filed every year to report the existence of this trust. And the penalties are very onerous. We are talking about 20,000 euros per missing return if the returns are not filed. So when I'm hearing these specific facts, for me, the major red flag or the major point of attention is to make sure that the trust returns are filed in France in due time.
Great tip. Let's see. Can you just briefly, Greg is asking about gifts, like large gifts to a nephew. I know the gift allowance is 100,000 euros that are exempt, but that's every 15 years. Is that correct?
Yes, but not with a nephew. So
Only
once
for a
again,
direct family
yeah,
member.
it will depend on if the if he's like if Greg is based in the US and he makes a gift to his nephew who is based in France, there will have no French gift tax to be paid. But my recommendation in this situation is to file a French gift tax return so I can assist with this process. But no tax will have to be paid. Only the only amount to be paid is a registration duty of 125 euros, irrespective of the amount of the gift. But if Greg is a French tax resident and he makes a gift to his nephews who is a US tax resident, then he will have to file this gift tax return, but he will have to pay French gift tax at the rate of 55%.
Okay. Let me see. David is asking with regard to the yuzu fruit setup where the children own the bear
Mhm.
ownership. Does that also work for stepchildren?
Yes, it does. And
Okay.
it makes a lot of sense. I've set up this structure exactly in this case for a couple who moved to Nice. Um, so they are not yet married. and the woman has a child from a previous marriage, and the husband, the soon-to-be husband, does not have any child, and he wants all his assets to go to his stepdaughter. And yes, we put in place this usufruct and bare ownership structure, which will save 60% inheritance tax on the share that will be transferred from him to his stepdaughter. Because in France, a stepdaughter, even if you adopt her, she will not be considered as a child, meaning that she will not benefit from the 100,000 euros allowance. It will be treated as a transfer between unrelated parties, meaning inheritance tax at the rate of 60%.
That's rough.
Mm.
Let's see. Tracy's asking about, and this is less about the taxes, but more about, because I know this has been in the news lately, if you have, like, say, a trust in the United States that says you want your, assets to go a certain way, or you have a will in the U.S., but it goes against the French rules about, like, I can't remember what they call it, that you're not
Forced
disinheriting
heirship. Yes,
heirs.
the forced heirship rules.
What is the status of that? Because I know there was a lot. There's like the EU had taken France to court or given them, kind of a deadline to say, hey, you need to fix this. Allow people to send the assets where they want them to go. That doesn't exempt them from the inheritance tax, but it can make sure the assets actually go where you want.
Yes, so I will try to be short on that. It's quite complex, but we can find ways to make sure that the French forced heirship rules will not apply, meaning that your freedom of testation will be uh, maintained, but it's to be sure that it will be enforced. And and these rules only apply if you become a French resident. So we are only talking of the situation where you become a French tax resident. But so if you are a French tax resident and you want to disinherit one of your child, if you don't have a French real estate, we will be able for sure to make sure that you can disinherit your child. If you have a French real estate, it might be more complex because there is a so-called compensatory levies, which has been introduced in 2021, which goes against the freedom of testation. But once again, we can think of, if it's really a strong wish of the family to exclude one of the heir from his rights, maybe because he is a drug addict, or I don't know, there can have many reasons for that.
Yep.
We can think of solution that can include trusts, that can include foreign companies, because this forced heirship, when you look at the law, it only applies on French-based assets. So what is unclear is, let's say you purchase your French property through a Monégasque, a Monaco company. Will it still be considered as a French asset or not? I think no, but each situation is different. But if the situation occurs, we will make sure to protect the wish of the client. And you are right, Tommy. It contradicts the European regulation, these new rules which have been introduced in France. And we believe at the firm that they could be challenged in front of French courts. So we are waiting for the case law to be rendered. But for now, nothing very clear on this point.
Thank you. We'll have to have you back to talk about that also. It is about 1:15, so I think we're going to wrap it up. Thomas, thank you so much for your time, and we'll definitely have you back on. And with that, I want to say thank you for everybody being here.
Everyone, au revoir, bye bye.